Ever wondered how the concept of buying and selling shares began? This tale takes us back to the 17th century, the age of exploration and ambitious ventures. The birthplace of the stock market as we know it today was none other than the vibrant city of Amsterdam. Picture this. The year is 1602. The Dutch East India Company, an enterprising business dealing in exotic spices and luxurious fabrics from the East, was looking for a way to finance their expansive voyages. The costs were high, and the risks even higher. They needed a solution that would spread the risk and drum up enough capital to keep the ship sailing. And so they came up with an ingenious idea. The company decided to sell shares to the public. Anyone who had the means could buy a piece of the company. As a shareholder, you would be entitled to a part of the company's profits, and more importantly, your loss would be limited to the amount you invested if the ship didn't return. It was a win-win situation. The idea was a hit, and soon shares of the Dutch East India Company were being traded in a coffee house, which would later become the Amsterdam Stock Exchange. This was the first time in history that securities, which includes not just shares but bonds and banknotes as well, were traded in an organized, regulated manner. The establishment of the Amsterdam Stock Exchange marked the beginning of a new era. It introduced the world to a system where businesses could raise capital from the public, and anyone could invest in a company and share in its success or failure. This concept revolutionized the economic landscape and laid the foundation for capitalism as we know it today. Thus, the world's first official stock exchange was born, setting the stage for a financial revolution. This was just the beginning of a journey that would see fortunes made and lost, economies rise and fall, and the birth of the financial world as we know it today. As the concept of stock trading spread, London couldn't stay far behind. In the heart of the 19th century, the London Stock Exchange emerged as a titan of global trade. Its birth was a testament to the city's economic prowess, an institution that would soon shape the financial landscape of the world. The London Stock Exchange was more than a marketplace for stocks and bonds. It was a hub of innovation, a nexus where ideas, capital, and ambition intertwined. This was where the world came to invest, to speculate, to dream. From the bustling streets of the city of London, the exchange echoed with the whispers of traders, the clatter of ticker tape, and the boom of the gavel. It was a symphony of commerce, an orchestra of opportunity. As the 19th century gave way to the 20th, the influence of the London Stock Exchange was undeniable. The London Stock Exchange ushered in a new era of international stock trading. A little closer to home, Wall Street was making its mark. The Wall Street we know today, the bustling hub of finance and commerce, had humble beginnings. It was in the late 18th century, a time when New York was still a developing city, that 24 brokers huddled under a buttonwood tree on Wall Street. These brokers were not just meeting for a casual chat, they were about to change the course of financial history. In 1792, these brokers signed what is now famously known as the Buttonwood Agreement. This agreement was the foundation stone of the New York Stock Exchange, and it set a precedent for all trading in the financial market. The brokers agreed to trade securities only amongst themselves, setting a fixed commission rate. This was a revolutionary move that brought order to the chaotic trading that was prevalent during that time. Over the years, Wall Street evolved, turning into a financial powerhouse. The New York Stock Exchange moved from the Buttonwood tree to a coffee house and then to its own building in 1865. Wall Street grew, not just in the number of brokers and traders, but also in the volume of trade and the influence it had on the economy. The late 19th century saw Wall Street gaining global prominence. It was during this time that the concept of a centralized location for trading stocks was truly embraced. The idea that one could buy and sell ownership in a company, and thereby participate in its success, or failure, was a game-changer. The establishment of the New York Stock Exchange and the evolution of Wall Street weren't just about creating a venue for trading, it was about creating opportunities, forging partnerships, and building an economy. It was about creating a platform where dreams could be realized, where fortunes could be made and lost, and where the pulse of the nation's economy could be felt. And so, Wall Street began its reign, a reign that continues till today. It's a story of evolution, of triumph, and of relentless pursuit of economic growth, and it's a story that is still being written. But it wasn't always smooth sailing. The stock market has seen its fair share of crashes. One such crash that looms large in our collective memory is the stock market crash of 1929, a cataclysmic event that served as the opening act for the Great Depression. It was a time of wild speculation. The Roaring Twenties had seen an unprecedented economic boom, and the stock market was the neon-lit high-stakes casino where fortunes were made overnight. But like all bubbles, it was bound to burst, and when it did, it was devastating. The fateful day was October 24, 1929, known as Black Thursday. Panic selling kicked off a downward spiral that would continue for several years. By the time the market bottomed out in 1932, stocks had lost nearly 90% of their value. But the stock market crash was more than just a financial disaster. It was the spark that ignited the Great Depression, a decade-long period of economic hardship that affected nearly every corner of the globe. Unemployment soared to 25% in the United States. Banks failed, businesses shuttered, and millions of people found themselves without a safety net, struggling to make ends meet. The crash also led to fundamental changes in the way the stock market operates. In its aftermath, the government stepped in to regulate the market and protect investors. The Securities and Exchange Commission was created, and new laws were passed to prevent such a disaster from happening again. Despite these safeguards, the stock market remains a risky business. There's no such thing as a sure bet. And while the market has rebounded and grown exponentially since those dark days, the specter of 1929 still hangs over Wall Street, a grim reminder of what can happen when speculation runs unchecked. The Great Depression served as a harsh reminder of the volatility of the stock market. It was a painful lesson, but one that has shaped the way we approach investing to this day. It serves as a stark warning of the dangers of unchecked speculation and the importance of prudent, informed investing. And who can forget the infamous Black Monday? Picture, if you will, a day that goes down in history as one of the most catastrophic in the world of finance. We're traveling back in time to the 19th of October, 1987, a day when the financial world woke up to a nightmare, a day now known as Black Monday. This was not a gradual slide into chaos. Rather, it was a precipitous fall, a free fall if you will, that sent shockwaves across the globe. The Dow Jones Industrial Average plummeted by an unprecedented 22.6%, the largest one-day percentage drop in history. But what caused such a dramatic fall? A multitude of factors contributed to this historic crash. Among them, a surge in market volatility, aggressive trading strategies, and computer-driven trading models that exacerbated the sell-off. This was a time when the world was getting a taste of computerized trading, a system that was still in its infancy. The machines were programmed to sell when prices fell, creating a vicious cycle of selling that spiraled out of control. The automated sell orders kicked in, and the downward spiral was unstoppable. The effects of Black Monday were not confined to Wall Street. Echoes of the crash resonated across the globe, from London's financial district to the bustling markets of Hong Kong. This was a global phenomenon, a stark reminder of our interconnected world. Investors were left reeling, portfolios were decimated, and confidence in the markets was severely dented. It was a wake-up call for regulators too, who were spurred into action, implementing a series of reforms aimed at preventing a recurrence of such a catastrophic event. Yet despite the turmoil, the markets eventually recovered. But the memory of Black Monday lingered, serving as a stark reminder of the volatility and the risks inherent in the stock market. It was a lesson in humility for all, a reminder that the forces that drive the markets are not always within our control. Black Monday shook investors worldwide, reminding them of the risks inherent in the stock market. As the digital age dawned, a new kind of bubble began to form. With the rise of the internet in the late 90s and early 2000s, a frenzy of speculation and investment swept the tech industry. This period, often referred to as the dot-com bubble, was characterized by a rapid rise and equally swift fall in the valuation of internet-based companies. In this era, the allure of the internet as a new frontier for business was irresistible. Startups were sprouting like mushrooms after the rain, each promising to be the next big thing. Investors were throwing money at these companies, often with little understanding of their business models or even if they had a viable product. The stock prices of these companies soared, driven not by their earnings or assets, but by the sheer speculation of future profits. But as we know, what goes up must come down. By the early 2000s, the bubble had burst. Many of these dot-com companies, unable to turn a profit or even bring a product to market, went under. The stock market plummeted. It was a harsh wake-up call for the tech industry and the investor community. But from the ashes of the dot-com bubble, a new era of tech entrepreneurship was born. The survivors of the crash, companies like Amazon and Google learned the hard lessons of the bubble. They understood that while the internet was indeed a transformative technology, it was not enough to simply have a .com in your company name. A viable business model, a solid product, and a path to profitability were just as important. The dot-com bubble was a period of irrational exuberance, a time when the rules of business were thrown out the window in favor of wild speculation. But it also served as a crucible for the tech industry, a trial by fire that helped shape the giants of today's digital economy. The dot-com bubble burst served as a cautionary tale about speculation and overvaluation. It's a reminder that while the stock market can offer substantial rewards, it's also fraught with risks, and those who forget the lessons of the past are doomed to repeat them. Fast forward to the 21st century, and we find ourselves in the grip of another financial crisis. The year was 2008, and the world was about to witness one of the most severe economic downturns since the Great Depression. The crisis originated in the United States, but its shockwaves reverberated around the globe, affecting economies far and wide. At the very heart of this crisis was the housing market. A speculative bubble had formed, fueled by risky lending practices and a belief that house prices would continue to rise indefinitely. Banks and other financial institutions had issued a colossal amount of subprime mortgages, loans given to borrowers with poor credit histories. These risky loans were then bundled into complex financial instruments and sold on to investors. As the housing bubble burst, these mortgage-backed securities plummeted in value. Financial institutions around the world found themselves holding toxic assets, causing a severe liquidity crisis. Banks stopped lending to each other, businesses, and consumers. This led to a downward spiral of falling asset prices, business failures, and job losses. The stock market wasn't spared either. Overconfidence turned into panic, and stock prices plunged. The Dow Jones Industrial Average, a key indicator of the health of the stock market, dropped by more than 50% from its peak in October 2007 to its lowest in March 2009. The effects of the 2008 financial crisis were not confined to the financial sector. It transformed the way the stock market operates. The crisis highlighted the need for more stringent risk assessment and better regulation. It prompted governments and regulatory bodies worldwide to tighten their oversight of financial institutions and markets. And so, the 2008 financial crisis served as a stark reminder of the potential dangers of financial speculation and the importance of prudent risk management. It reshaped the global economy and left an indelible mark on the stock market. The 2008 crisis changed the financial landscape, prompting a rethink of risk and regulation. So, where does that leave us today? In the modern era, the stock market is more accessible than ever before. Gone are the days of physical trading floors bustling with brokers shouting orders. Today, the world of finance has largely moved into the digital domain. The rise of digital trading platforms has revolutionized the way we interact with the stock market. With just a few taps on a smartphone, anyone can buy and sell stocks, bonds, and other financial instruments. This convenience has led to an explosion in retail investing, with a new generation of traders stepping into the arena. But this democratization of stock trading isn't without its challenges. With easy access comes the risk of uninformed investing. The proliferation of digital platforms has made it easier for individuals to jump into the market without a solid understanding of its complexities, potentially leading to risky financial decisions. Moreover, the advent of algorithmic trading and high-frequency trading has dramatically increased the speed and volatility of the market. Machines, programmed to execute trades based on a set of predefined rules, can react to market changes in fractions of a second. This has led to an entirely new set of dynamics that investors must navigate. Furthermore, the rise of cryptocurrencies and other digital assets has added another layer of complexity to the financial landscape. These new forms of investment, though promising, are still largely unregulated and can be extremely volatile. Despite these challenges, the stock market continues to be a vital part of the global economy. It provides companies with the capital they need to grow and innovate, and it offers individuals the opportunity to share in that growth. The stock market has come a long way from its humble beginnings, evolving with the times and shaping the world economy in the process. Indeed, as we move further into the digital age, the stock market will continue to adapt, presenting new opportunities and challenges for all involved.